3. Foreign Soil Business Tax. All goods made in foreign lands, either by U.S. citizens or foreigners, will be taxed an additional 10% wholesale value upon entering the U.S. This will encourage all businesses to remain in the U.S. and reduce exploitation of overseas labor. 4. Fossil Resource Tax. All fossil fuels and fossil fuel byproducts shall be taxed 12.5% to the retailer and an additional 12.5% to the end buyer, calculated after retail markup and before sales tax. This is applied atop the U.S. average combined tax of 42 cents per gallon, using gasoline for an example, adding approximately an additional 49 cents per gallon. These taxes shall create more responsibility in these companies and slow the consumption of these soon-to-be-banned resources and their entourage of dangerous products. This will funnel inventive thought towards renewable energy sources and the innovative use of natural materials. This tax shall cover not only all known fossil resources, but also their byproducts, including, but not limited to, plastics, artificial flavors, scents, and colors, as well as any fossil, petrochemical-derived drug, coating, additive, or product. This covers many products in the market, and thus shows the overuse of fossil oil, and how little or no steps are being made to create products from other mediums. Depending on the drop in consumption, the prime directive, the additional revenue generated from the just fuel tax, using the 2004 figures of 140 billion gallons of gasoline and 40 billion gallons of diesel consumed, would be approximately $88.2 billion annually. The revenue from the various other products affected by this tax shall also be a substantial figure. However, the actual aim is to stop the use of these fossil resources altogether, not to attempt to generate additional revenue. 5. Hazardous Material Tax. Any man-made material that is found to be harmful to any form of life to any degree is taxed 12.5% to the retailer and an additional 12.5% to the end buyer, calculated after retail markup and before sales tax. This will reduce the use and production of many pesticides, industrial chemicals, cleaners, volatile chemicals, etc., and cause the focus upon more natural and friendly solutions to increase. 6. Junk mail tax. Ad mail is a direct result of a materialistic society. The only purpose of this wasted material is to make a sale. U.S. companies alone distributed 100 billion pieces of ad mail in 2005. At 2 cents per copy, this amounts to $2 billion per year. The amount of energy spent to generate this in paper, ink, shipping, and distributing is shameful when it could have been used for the free education of the public instead. This amounts to 300 pieces of mail for every U.S. citizen. Think of how much knowledge could have been placed on each of those pages. 44% of this mail is never even opened. Even less of it is actually responded to. Less than 36% of this mail is recycled, costing taxpayers an estimated $275 million per year to dispose of it, amounting to 5.8 million tons of junk mail ending up in the solid waste system each year, which is tens of millions of trees wasted every year. The amount of such mail increases the size of the postal system, whose increasing operating costs come back to the citizen. This is a blatant waste of money and energy from every angle. Therefore, the individualists invoke the junk mail tax. For every single page of ad mail to be mailed, the mailer must purchase a 3-cent stamp in addition to the base mailing fee. Thus, the tax is 3 cents per page, resulting in an approximate 150% tax. This is to abolish this practice for good and make those who continue to use it to have a very important message, thereby causing more people to actually read it. This generates a rough estimate of $2 billion additional revenue in the first year. 7. Large Entity Tax. All companies over 100 people must pay an additional large entity tax, which is 0.1% of their profit per every 10 people over the 100-person limit. Thus, a company with 998 employees will pay 8.9% in additional taxes. This controls the speed of growth of companies, leveling off the playing field. This makes it difficult for any company to become a controlling force separate from the people, as well as making a company plan with more care and efficient method of expansion to warrant the increased taxes. Limiting the size of businesses leads to a maximum efficiency between competing companies, just as limitations on NASCAR engine specs do the same between engines. The larger a business becomes in this system, the more it returns to the populace. The more the populace then cares for it. The more the business then cares for the populace. inspiring efficient, innovative solutions, thus expanding and continuing a cycle of firm, healthy growth, as opposed to the malignant and hastened, weed-like growth of the present world companies, where cheap solutions are encouraged and their pointless products use the people instead of assisting them. This helps younger companies start with just their ideas, keeping most of the profit for themselves and enabling them to reinvest more into their company. As one may notice, companies of over 5,000 people begin to pay more to the populace than to themselves. With over 10,000 people, the company works strictly for the benefit of the populace, but is still operated by private forces who dictate their own salaries. This is the origin of the 2110 law. When a business reaches 2109 employees, the business and personal tax rates become the same. After 2109 employees, the business tax rate grows larger than the personal. Thus, the founders may make their salaries substantially large to absorb the profit and pay less of these higher taxes. This is protected by the 2110 law, listed here again. Any paid member of a company which has over 2,110 employees, whose salary is at least 1% of that company's worth, is considered a vital mechanism. In other words, more part of the company than an individual, and thus pays the current company tax for his income rate as opposed to the flat rate of 12.46% for individuals. This keeps the profits of the companies benefiting the populace and stops the hiding of profits by distributing them to the elite, while still allowing for substantial profits of said elite. 8. The packaging tax. The current amount of plastic, synthetically coated papers, and paperboard used as packaging is unacceptable. Most of these materials are not able to be efficiently recycled, if at all. Even those that are recyclable are too often discarded into the solid waste system, and not properly marked as to what type of plastic they are. All environmentally unsound products in packages such as these are therefore taxed 12.5% to the retailer from the manufacturer and an additional 12.5% to the end buyer calculated after retail markup and before sales tax. This includes any plastic package or wrapping in any form, be it a sheet, bottle, box, or petrochemical-derived wax, papers, and paperboard. This forces wrappings to be of untreated paper and paperboard, glass, foil, cellulose-derived cellophane, plant or animal wax papers, excludes petroleum-derived paraffin, etc. This type of packaging is more easily handled by the environment in a reasonable time frame. Glass and foil are recyclable and can occur naturally as opposed to plastic. Although some plastics may be recyclable, many humans do not participate, thus these substances end up in nature's hands. This tax helps reduce this problem, as well as encourages companies to use safer packaging and make efforts to develop innovative packaging materials. 9. Primitive vehicle tax. To ensure the development of advanced electric motors and battery technology, along with the phasing out of fossil fuels, all vehicles will be taxed if they utilize any form of internal combustion engine. The degree of the severity of this tax, with gasoline being the most heavily taxed, is as follows. 1. Gasoline, 6%. 2. Fossil diesel, 5%. 3. Gas or diesel hybrids, 4%. 4. Ethanol, 3%. 5. Propane and methane, 2%. 6. Hydrogen and biodiesel, 1%. Any fully electric vehicle with no onboard internal combustion engine is not taxed. This tax will be paid upon purchase of the vehicle, 12% by the dealer from the manufacturer, and an additional 12.5% to the end buyer calculated after retail markup and before sales tax. This will encourage the phasing out of the fossil fuel-based engines which maintain a society of consumption. It will additionally encourage research into electric vehicle technologies on a much larger scale. 10. Unnatural Foods Tax. All foods which utilize any enhanced, synthetic, or additive which does not naturally occur without the presence of man is deemed unnaturally enhanced and taxed 12.5% to the retailer from the manufacturer and an additional 12.5% to the end buyer calculated after retail markup and before sales tax. This includes, but is not limited to, any plant or animal with genetic alterations not acquired by selective breeding. Any plant or animal enhanced with hormones either man-made or extracted by man from some other source. Any plant or animal fed any man-made chemicals. Any plant or animal sprayed or powdered with any man-made chemical. any plant or animal raised and or kept in an inhumane and or unsanitary environment, thus an unnatural environment. Any food with man-made additives or preservatives of any kind. Any food with partially or fully hydrogenated oils. Note, man-made is defined as a substance that cannot naturally occur without the presence of man, and or any man-made imitation of a naturally occurring substance. Note 2. Food is defined as anything ingested to be used by the body. One can see that this discourages the damaging use of the chemical industry's fertilizers, pesticides, mold inhibitors, artificial additives, and preservatives, as well as the synthetic drugs from their partner, the pharmaceutical industry. Sadly, it covers nearly all of the available foods, which shows how tainted the food supply has become. This will greatly assist the health and longevity of the society as a whole, while encouraging people to create more of their own food, making food safer for the populace and making them more conscious of what they are eating. The revenue generated from this could be calculated roughly from the U.S. food industry's sales of approximately $600 billion annually, minus the mere $14 billion in totally organic foods, yielding an estimate of $109 billion in additional tax revenue.